What's up, traders? Today we're going to talk about EMAs and SMAs, what they are, and how they're used. So let's get to it. Okay, traders. So to trade stocks using what you see on the chart, you'll first need to choose a time period. So now these time periods, they can range from, the 1 minute, the 2 minute, which is what I use, 3 minute, 5 minute, 30 minute, 1 hour, 4 hour, or you can even trade on the daily if you're more of a swing trader. So the resulting chart will actually show you these vertical bars, and they're otherwise known as candles, to go back to basics a little bit. So with each bar, it's actually going to represent the time period that you've chosen. So if you're on a 1 minute chart as we are here, or if you're on a daily chart as you are here. So you can actually take a look at what each day's range was for that day. So then the charting software will actually let you add in different technical indicators. Now, these technical indicators that we're going to talk about today are the EMAs and the SMAs. So what they do is they'll plot their lines on the chart to basically kind of give you an average of what all these bars or candlesticks are actually doing. So an exponential moving average, or the EMA, is a tool that the traders will use to watch the trend within the stock. And you do that with the SMA too, but it's a little bit different than, the SMA. SMA, the simple moving average, was actually one of the first among traders, as it was a little bit easier to figure out, because the SMA actually will take the average of the moving period that you're looking for and add it up and divide it and give you an average. And then it will make the line based off of that number. So for example, if you take this blue line, which is the 9-day moving average, what it's doing is it's actually taking the closing price of the last 9 bars. So when a new bar is then started, the oldest price will then drop out of the average, and the closing price of the last bar is used to update and plot the average of the new price bar. So as you can see, all it's doing is taking, so if you were using the 20, which is this white line, it would do 20 bars instead of 9. So hopefully that makes sense. The differences of the EMA is that an exponential moving average works the same as a simple moving average, except that the most recent prices are given more weight in the average than the older prices. So say we're doing the 9-day moving average, you take the first 6 bars of those 9 bars, they'll actually get the same weight as the most recent 3 bars. So it kind of weighs more in favor of the most recent bars within the pattern. So the result is actually a moving average line that will more closely follow changes in the stock price as the bars form, which I'll show you here in a little bit. So the indicator gets its name because of the charting software, which will reduce the weighting of older prices by an exponential amount, which is compared to the newest closing price. As a result, the EMA gives you more weight to recent prices compared to the SMA, which the SMA gives you the equal weight to the prices within that moving average period. So now the EMA trend indications, the EMA chart lines with different periods, such as a 9 or a 20 or a 50 or 100 or 200 even, which we'll get to in a little bit, can be used to clearly see the slope of an EMA line. So as you can see, these are SMA lines right now, but it's going to look very similar with the EMAs. So when the price actually crosses on the EMAs, traders will often view that as a price trend reversal. So shorter period EMA lines can show whether the trend is changing, and for longer periods, as the 50, 100, and 200 periods, they will actually show and start to be used as price resistance and support levels. So with that said, and if you have any questions, maybe go back and take a re-listen or leave a question down below and we'll get to it. But we'll look at RKDA real quick. So right now I'm only using the 9 and the 20. And I'm actually going to load up the 50, which is this pink line, the 100, which is the yellow line, and the teal one is the 200, and the dotted white line is VWAP. So basically what we're looking at is a cluttered chart, and this is why I don't trade like this anymore. But a lot of people like to see all these averages, and that's how they like to trade. But in general, what you're looking for is the 9 and the 20, or some people even use the 10 instead of the 9. They're basically looking for these crossovers. So if you can tell, back here at the bell, she kind of dips down and comes up, and then she starts to try to cross over. As you can see, she kind of fails, but then she finally does make that crossover, and look what happens. She actually comes and makes a nice move up, and she starts to consolidate, and she goes to cross back under but never does, and look what happens. So she started consolidating, she didn't do the crossover back down, and she took off again. Now she started consolidating again, and she finally did cross over here, and look what happens. You get a nice little trend reversal, and she falls down. So there's all kind of different things that you can look for with these EMAs, but that's really the general one that everyone's looking for, is the 9 and the 20, which is on the 1 minute chart, by the way. If you try to change the 9 and the 20, or if you put the 9 and the 20 on, say, a 2 minute chart, it'll actually, so let's just kind of take a look at this, and if you change it to, we'll go to the 3 minute to show you a little bit more. Of course, it's going to change the day on me, isn't it? Sure did. Let's do, I got to change it to 15 day to go back. We're going to look for that 10, there it is, okay. So when we changed it, obviously the bars are a lot, more compacted, because now they're 3 minute bars instead of 1 minute. But as you can see, now look at the 9 and the 20. It actually gives you a better reading to me, but these EMAs, or SMAs in this case, are going to look a lot different than the 1 minute chart, because the 1 minute chart, you're going to be getting a lot more movement because you're getting 3 bars for every 1 bar that you're getting here. So everyone's going to be seeing a different thing on different time frames, because on a 3 minute chart, it's going to be a lot more smoothed out per se, because on a 1 minute chart, you're going to be jumping up and down, because say in just this one candle here, you're going to have 3 candles. So you're going to have like one here, another one here, and another one here per se. And it's going to make this line, it's the SMAs using those 3 bars, whereas in this case, it's only using 1 bar. So let's actually go back to the 1 minute, because that's what most people are looking at. Of course, I need to go to the 15 minute. Oh, that's 1 day. 15 day, 1 minute. There we go. Okay, so let's go back to our chart real quick. Okay. And so now what I'm going to do is I'm going to show you the difference between the SMA and the EMA. So I'm going to load the study set of the EMAs. Now keep an eye right on that same spot right in here. We're going to look for that to change, so you can see the difference between the SMA and the EMA. Okay, now what did you see? What we saw was these lines kind of drop down. Now the reason we saw these drop down, again, is because it's using more weight on the front end of the candles within the pattern. So when this came up on the SMAs, you saw it kind of looped up like this and then came back down, because it's still using older candles with, the overall average, because it's all equal. Now with the EMAs, what it's doing is when you get these 3 red candles on the 9 minute chart, it's taking those 3, and this isn't an exact science, I'm just using it as an example. I'm not exactly sure how the algorithm works, but you would essentially take these 3 candles and give it the same amount of weight as the 6 previous candles. So what it's doing is it's bringing the line down a lot quicker, because the price at the beginning here came down quicker. So a lot of people would like to use the EMAs because they can see the price action happen quicker. However, a lot of people use the SMAs because it kind of smooths everything out, and that's what a lot of people are using in the first place. And when you're trading and you're looking for these breakouts to happen, you want to be looking at what everyone else is looking at, because then you can kind of predict what's going to happen. That's the idea of the market. So now we're going to go back to the SMAs, since that's what most people are looking at. And as you can see how now it's a little bit more rounded, and you get a different thing. And of course, it's going to make your crossovers different. It's going to make everything different if you're using EMAs versus SMAs. So if you're looking for this same crossover as someone that's looking at it so let's see, well, the crossover happens here. We'll say right here on this candle at 11:03, real quick. we'll go to the EMAs. That crossover doesn't happen until over here at 11:08. So that's a 5-minute difference because these green candles are more weighted than the overall weighted price of the, or non-weighted price, I should say, of the SMAs. So it's taking these green candles into account, which brings it back up. As you can see, there's like a little jagged edge right here, like coming straight across. With the SMA, you're not going to see that because it smooths it out because it's a nice weighted price, as you can see right here. See how it's a lot more smoother looking. So real quick, let's talk about the 50, the 100, and the 200. And a lot of people will use these as, resistance support levels more so than actual trade lines. And that's the other thing too, is the 20 is considered the trade line. You'll notice that on a good day where a stock's nice and powerful, it'll usually get above the trade line, and then when it's on a good trend, it'll stay above it. So as you can see here, like she's above it, comes back down to it, bounces off of it, and goes and makes another run. And then when she goes under it, that's when she decides to make a little bit of a reversal in trend, and she consolidates, and she decides that she wants to go for a little bit more. She gets back above the trade line, and sure enough, she comes up and hits it again. So over here, we'll actually use the 50 as a good example. Some people will see the 50 doing its thing, and when it comes down, it'll look to bounce off of the 50 because it's one of the moving averages a lot of people are looking at. The same thing usually goes for the 100, which it looks like in this case, you kind of have one here where, and that's the other thing too, you can use VWAP. VWAP is probably the most widespread used moving average. It's the volume weighted moving average. So it's one that everyone should have on their chart, in my opinion, because especially if you have, say, the 100 or other moving averages coming up and connecting with VWAP, the odds are most people are going to see that and look at it as a strong area of support. And in this case, as you can see, she comes down, she's consolidating, she's not sure what she wants to do, but then the 100's coming up with it right here at VWAP, and then look at what happens. She starts to make a nice little move. So with the 200 moving average, that's usually one of the more main ones that people look at, more so than the 50 and the 100. The 50 and the 100 are more so, more of quick bounce scalp type plays. But the 200, a lot of people will look at as like an actual, trend reversal area as a major support or a major resistance area. So, and right here's a good example. She actually comes up and hits high a day and then just has a huge flush. And she comes right down to where the 200 happened to be coming up and meets with the VWAP. And look what happens. She decides that's where she's going to get bought up and stop, because a lot of people are saying, okay, we got VWAP, we got the 200. That's two big moving averages that are coming in line with each other. So it should be a good area of support. And sure enough, she tries, but the selling pressure just from this move decided she wasn't done. She actually does get through the 200. And all these guys are saying, hey, because if you really look at it, sure, the 200 goes up a little bit, but if you're looking at it from a side point, she's still holding that same support level. And so people start to buy it back up, but, there was just no one else. The bulls said, okay, we're done. We made our money, or, we just lost our money. I'm done. And as you can see, the rest of the day, she just decides to kind of consolidate and die off. So with that, guys, I think that covers the EMAs and SMAs for the most part. If you have any additional questions, leave them in the comments section below. I'll gladly get to them. Maybe we can refurbish the video in the future, add on to it. Like and subscribe if you haven't already. I'd appreciate that. Hit the notification bell to let you know when I upload a new video. And tomorrow's Monday, so hopefully we can get a nice trading day in, and I'll talk to you then. Peace.